In my opinion, one of the most interesting investors to keep up with is Bill Ackman. Ackman is the founder and CEO of Perishing Square Capital Management and has amassed a net worth of over $9 billion. I've personally learned a lot from listening to his investment philosophy, which he describes in this clip.
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it.
So in this video, we're going to be analyzing all 7 holdings in his portfolio, and to do this, we'll be using my ticker data powered spreadsheets, which you can download on tickerdata.com at the link in the description. Now let's go ahead and jump in. Now the first and largest holding in Bill Ackman's portfolio is stock ticker CMG, and this stands for Chipotle Mexican Grill. And you can see all this data is going to automatically load in thanks to the help of the ticker data add-on. Now this position is over 20% of his current portfolio, and the company actually just had a 50-for-1 stock split, making the current share price sitting at $55.29 per share. If we jump over to Seeking Alpha, we can see over the past year they've actually done really good, up nearly 30%, but if we actually look at them in the past month alone, down by about 17.38%, so that's a pretty big jump down. Now in the past 5 years, this company has performed very, very well, up nearly 280%. And if we go ahead and jump over to our stock screener sheet, let's come up here, plug in CMG and hit enter. And we can see all this data is going to automatically load in. Now, immediately we can see quite a few things that we like. First off, revenue per share has exploded over the past decade, going from about $2.08 to in 2023 all the way up to $7.17. And like Bill Ackman stated earlier in that short clip we saw, we can see free cash flow has been predictable and it has been growing, especially over the past few years at a pretty high rate. In 2020, free cash flow per share a little bit lower than it had been the previous years, but it was sitting at about 21 cents per share. But in 2023, it jumped all the way up to 89 cents per share. So that's a pretty big jump during that short time period, and earnings per share has followed as well with staggering growth. We can see the company has been buying back some shares over the past decade, and if we jump over to the profitability spreadsheet, one of the things we can also see is double-digit revenue growth over the past 5 and 10 years, and double-digit net income CAGR over the past 5 and 10 years as well. But what's really interesting is if we look at the gross profit ratio, we can see some serious increases since 2016. Now, before 2016, it looks like it was hovering around 26 or even 27%, and it dropped all the way down to about 12.76% in 2016. But since then, we've seen it recover pretty quickly, and in 2023, gross profit ratio was sitting at about 26.2%. Now, if we jump over to the dividend breakdown sheet, come up here, plug in CMG. Now, what we can see is a lot of this data is not going to load in because this company actually doesn't pay a dividend, but this gives us some interesting insights and perspective into what the main focuses are for this company right now. So keep in mind, there's 5 different things a company can do with free cash flow. They can reinvest it back into the business, pay out dividends, buy back shares, they can pay down debt, or attempt mergers and acquisitions. And it looks like the main focus for this company right now is reinvesting back into the business. And this is probably one of the reasons they've had so much free cash flow growth over the past decade, among other reasons. But when we look at the free cash flow growth over the past 10 years, we can see in 2023, they had about $1.2 billion in free cash flow, and in 2013, it was sitting at about $328 million. So pretty phenomenal growth. That's a 14% free cash flow CAGR. And finally, if we go over to the balance sheet breakdown, plug in CMG. Now, when I look at the balance sheet, one of the 2 main things that I focus on are the current ratio and the debt to assets ratio. And what the current ratio tells us is how easily a company can meet their short-term debt obligations. And basically what this is, it just takes the total current assets and divides it by total current liabilities. And we can see in the case of Chipotle at the end of 2023, total current assets sitting at about $1.6 billion, while total current liabilities sitting a little over $1 billion. So that put their current ratio at about 1.57. So typically we want to see this number above 1 or above 1.2, and they are above that threshold. So it looks like they're in pretty good shape. And the debt to assets ratio, this is just total debt divided by total assets, sitting close to around 50%, and it consistently has since it looks like 2019. So it looks like it's in a healthy range, and we like the consistency. Now, with all this being said, we can actually see Bill Ackman has been reducing this position for the last few quarters. We can see in Q1 of 2024, he reduced his Chipotle position by about 9.82%, and in Q4 of 2023, he reduced his position by about 13.49%. Why is this? Well, he was actually asked, and this was what he stated. What started out as a large position recently became a massive one, in excess of 20% of capital. We sold stock earlier this week only for portfolio management reasons. Now, keep in mind, this quote was from 2020, so it is possible his thesis has changed, but still, there is no doubt he's been greatly rewarded from holding this position. Now, the second largest holding in his portfolio is an interesting one, and it's one that I've never covered on the channel before, but we can see that stock ticker HLT, Hilton Worldwide Holdings, and this makes up about 18.2% of his current portfolio. If we go ahead and jump over to Seeking Alpha, we can see over the past year, it's done really well, up by about 47.51%. And if we look at them in the past 5 years, up by about 120%. If we go ahead and jump over to our stock screener, click down here, come up here, plug in HLT, and the data will load in. Now, unlike Chipotle, we can see they actually do pay a small dividend, starting dividend yield sitting at about 0.27%, but it is a very low payout ratio. Now, we can see free cash flow per share 2020 and 2021. It took a pretty big dive down, and we can see this was reflected in the share price. The company was trading as low as about $56 per share. But we can see in 2022 and 2023, free cash flow per share recovered, and it actually reached all-time highs in 2023 at $6.48 per share. And they actually saw pretty good levels of return on invested capital in 2022 and 2023 as well, sitting at about 19.5%. That's a sign of a high quality company. Typically, we like to see a little bit more consistency, but over the past few years, ROIC has definitely been pretty solid. Now, if we jump over to the profitability sheet, come up here, plug in HLT. And one of the things we can see on the profitability spreadsheet, first off, earnings per share was down negative in 2020, negative 2.6, and the gross profit ratio was down pretty significantly. And it looks like Bill Ackman actually took advantage of this. If we scroll all the way down, we can see in Q1 of 2020, Bill Ackman was buying a lot of stocks, and one of those was Hilton Worldwide Holdings, HLT. He added a pretty significant stake to his portfolio, so he definitely took advantage. If we jump over to the dividend sheet, plug in HLT, we can see the company has paid a dividend, and it is currently paying a dividend with a yield at 0.27%, but it's pretty insignificant overall, and we can see there's not a lot of consistency with those dividend payments. The third largest position in Bill Ackman's portfolio makes up 17.24%, and that is QSR. And that is Restaurant Brands International. Like I said, allocation at 17.24%. And we can see this company actually has a decent starting dividend yield, sitting at about 3.1%. And if we jump over to Seeking Alpha, over the past year, it's been pretty flat, down by about 3.25%. And over the past 5 years, again, pretty flat, up about 2.79%. Now, if you aren't familiar with this company, if I scroll down, this is basically a company that owns a few different restaurant brands. We can see companies like Burger King, Popeyes, Firehouse Subs. And if we go ahead and jump over to our stock screener, we'll come up here, plug in QSR and hit enter. And we can see revenue per share has kind of been all over the place over the past decade, but definitely quite a bit higher than it was back in 2013. 2023 revenue per share was sitting at about $23. EPS in 2023 sitting at about $3.88. Now, we can see the free cash flow yield for this company is decent, sitting at about 5.24%. Now, what does this mean? Well, free cash flow yield is simply our free cash flow per share divided by the current share price of the company. So basically, it's letting us know as an investor, when we buy one single share in the stock, how much free cash flow are we getting for that single purchase? And our free cash flow yield is telling us to be about 5.24%. So it's kind of a valuation metric that's somewhat decent. If we jump over to the dividend breakdown sheet, we can come up here, plug in QSR, and we can see all this data will automatically load in. Now, the starting dividend yield for this company is sitting at about 3.1%, but we can see this company is using the majority of their free cash flow to pay out dividends. Like I said, a company can use their free cash flow in 5 different ways, and one of those ways is paying out dividends. So the free cash flow payout ratio sitting about 81%, doesn't leave a lot of capital left over to reinvest back into the business or do things like pay down debt or even buy back shares. Now, we can see the free cash flow has been covering the dividend payment for the entirety of the past decade, but the free cash flow payout ratio has continued to climb higher and higher, so not necessarily a good sign for the company. 10-year free cash flow CAGR has been very good because, like we saw, revenue per share has increased pretty dramatically over the past decade, but the past 5 years, free cash flow growth has been pretty slow. Now, the fourth largest position is actually also the 7th largest position, and I'll explain what I mean by that, and that is Google. Now, it's also the 7th largest position, except it's stock ticker GOOGL. Now, what's the difference in GOOG and GOOGL? Well, really the main difference is just going to be the voting rights. GOOGL is going to be Class A shares, while GOOG is Class C shares. So these shares actually give Bill Ackman voting rights within the company. What we can see, he has 13.27% in ticker GOOG and about 6.11% in GOOGL. So same company, just different types of shares. But if we go ahead and jump over to Seeking Alpha, we can see over the past year, Google's actually done really well. They're up about 46%, and like we already know, the past decade has been pretty phenomenal for them, up by about 537%. Now, we're all familiar with Google, but how exactly do they bring in their revenue? Well, if you're not familiar, we can get a pretty good overview here of Google's revenue breakdown for 2023. If we go ahead and zoom in, we can see ads make up the vast majority of Google's revenue. And this is coming from Google Search and other properties. But then we have YouTube ads. This is another big segment for the business, about $31.51 billion, which makes up about 10% of the entire revenue for this company. They then also have Google Network ads, about 10%. We have Google subscriptions, platforms, and devices, about 11%. But then we also have Google Cloud at about 10.8%. So these 4 revenue segments are pretty well diversified and all sitting about 10 or 11%. But then we have ads on Google Search and other properties, the vast majority sitting at about 57%. So if we go ahead and jump over to our breakdown sheet, come up here, let's plug in GOOG and hit enter. And the data we can see here is actually a thing of beauty. Look how good this revenue per share chart looks. We can see very steady increases year over year, and over the past decade, it's been pretty phenomenal, going from about $4.49 per share all the way up in 2023 to $24.34. And we can see the earnings per share and free cash flow per share for this company have followed as well, and they have very low debt to assets ratio, which we can touch on here in just a little bit. But look at this. Obviously, these 3 signs are a sign of a very healthy company, but they also have very consistent high levels of return on invested capital. Now, return on invested capital helps us understand how profitable are the projects that the company is investing to. So we can see in 2021, 23.5%, in 2022, 22%, and in 2023, 23.27%. And as a general rule, I typically like to see this above 10%. So when we start getting in that 20% range, that's a sign of a really high quality company in my opinion. So there's a lot to like here, and if we jump over to the profitability sheet, we can see something else that points to them being a very high quality company. Their gross profit ratio is high and very consistent. We can see that 10-year average gross profit ratio sitting at about 57.71%, and the gross profit ratio in 2023 sitting at 56.63%. Again, another great sign for this company. Now, they don't have a dividend history, but the company did just recently announce their very first dividend payment. Now, the starting dividend yield after this 80 cents dividend payment is still very low. It's sitting at about 0.44%, but obviously they have the ability to really increase this at a very high rate moving forward because the free cash flow growth has been so high. But finally, something that's interesting about Google. If we look at the balance sheet for this company, I think again, you're gonna like what you see. Like I touched on earlier, we can see the current ratio sitting at 2.1, so this is way above 1, so they can easily meet any short-term obligations, and the debt to assets ratio is very low, sitting at just 7%, so total assets about $403 billion, while total debt just $28.5 billion, so this company is absolutely drowning in cash. That's a pretty good problem to have. And so keep in mind, a company that has tons of cash on their balance sheet, plus they typically have pretty high levels of return on invested capital, that's a really good combination. I think we'll see a lot more growth coming from Google in the future. The 5th holding in Bill Ackman's portfolio is stock ticker HHH, and that stands for Howard Hughes Holdings. We can see this makes up about 12.72% of his entire portfolio. If we go ahead and jump over to Seeking Alpha, the past year has been a little rough for the company, especially with the market up so much. They're down by about 12.4%, and if you look at them in the past 5 years alone, down by about 43.83%. So it looks like Bill Ackman is definitely looking for a turnaround play here. Now, if we go ahead and jump over to our stock screener, come up here, let's plug in HHH. Now, for me personally, when I look at the fundamentals of this company, this definitely does not look like the type of company that I would want to own in my personal portfolio. So maybe Bill Ackman is planning on being more of an activist investor with this position. We can see earnings per share has kind of been all over the place over the past decade. Same is true with free cash flow per share, and there hasn't been a lot of revenue per share growth either. We can see they don't currently pay out a dividend, and return on invested capital has really never been too good, and in fact in 2023 it was pretty bad, sitting at negative 4.67%. If we look at the profitability sheet, we can see gross profit ratio has been increasing ever since 2020. The 10-year gross profit ratio average sitting at about 36.4, while gross profit ratio in 2023 was sitting at about 42.38. So this is definitely an interesting position for Bill Ackman. I'm going to be watching this one pretty closely because I'm pretty curious to see exactly how this plays out. And then finally, the last holding in his portfolio that we're going to look at is one that makes up about 12.37% of his entire portfolio, and that is stock ticker CP, Canadian Pacific Railway Limited. And this company actually operates in the industrial sector. If we jump over to Seeking Alpha, we can see over the past year, they're up by about 5.19%. If we look at them over the past decade, up about 115%, so nothing really too crazy from that standpoint. If we go ahead and jump over to our stock screener, come up here, plug in CP and hit enter, and this data will load in. Now, the performance over the past decade hasn't been super impressive, but here's what I do like to see. We can see consistent, stable, and predictable growth from revenue, free cash flow, and earnings per share. This is one of the things that he talked about in that short clip that we saw, and I agree. I pretty much like what I see right here. And for the most part, we can see return on invested capital has been above 10% for the majority of the past decade, but ever since 2020, it's actually dropped quite a bit lower. We can see 2021, 4.68, 2022, 6.95, and in 2023, negative 8.76. So that's definitely something that they're going to have to figure out. Now, during this time, we can also see the debt to assets ratio has decreased pretty significantly, going from all the way 45.61% all the way down to about 28.58%. So it looks like the balance sheet is getting cleaned up a little bit. If we go ahead and jump over to the profitability sheet, come up here and plug in CP. Now we can see the 5-year revenue CAGR pretty good, 11.41, and the 10-year pretty good at 7.43, and the 5 and 10-year net income CAGRs both above 15 or even 16%. So that's pretty solid. But what really surprises me about this company is how solid the gross profit ratio is for a company that operates in the industrial sector. We can see in 2023, this was sitting at about 50.78%. Now, I didn't mention this on the stock screener page, but this company actually does pay a dividend. So if we jump over to our dividend breakdown sheet, plug in CP. So the starting dividend yield for this company, pretty low, sitting at about 0.66%, but we can see the payout ratios are relatively low as well. The 10-year dividend CAGR is pretty good, sitting at about 8%, but over the past 5 years, they really haven't increased dividend payments that much, sitting at about 3%. But the good news is the dividend payments are backed by the free cash flow. Now, the free cash flow payout ratio over time, a little bit choppy, but we can see it's been in a healthy range for the majority of the past decade. It's pretty much always sat below 40%, with the exception of 2023 when it's gotten up to about 43%. And like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.